The central bank has raised the central bank rate, CBR, by 25 basis points. The Deputy Governor, Bank of Uganda, Michael Ating'I, says that the move agreed upon by the Monetary Policy Committee seeks to enhance economic stability.
The bands on the CBR remain at plus and minus 2 percentage points, and the margins on the CBR for the rate discount and the bank rate at 3 and 4 percentage points respectively. As a result, the rate discount and the bank rates will be 13.25% and 14.25% respectively. The increase in the CBR is a prudent measure to address heightened inflation risks.
However, significant upside risks to the inflation outlook persist. While the economy retains resilience, recent high-frequency indicators suggest a slight slowdown in near-term growth.
Uncertainty surrounding the global economic outlook, shilling depreciation, and tight domestic financial conditions could dampen domestic demand. Nonetheless, economic growth for financial year 2023-24 is forecast at approximately 6%, and the subsequent years are expected to hover between 5.5% and 6.5%.
The central bank also highlighted some of the impacts of the Kenyan shilling appreciation to Uganda and also commented on the proposed tax increment for agent banking.
It's going to make the Kenyan goods more expensive, because you recall that sometime in January, Ugandans were paying about 22, 23 Uganda shillings for 1 Kenya shilling. And last week, at the last check of it, it was about 29 Uganda shillings to 1 Kenya shilling. So certainly it's going to make imports from Kenya more expensive. Once you get cash transferred to you, it would be better if you don't withdraw it, because if that cash remains in the ecosystem, then it means that the demand for physical currency is reduced. So to the extent that the tax can increase the retention of that value in the ecosystem, I think it serves well for Bank of Uganda.
Short-term projections indicate inflation may rise to between 5.5% to 6% within 12 months ahead, with a return to the medium-term target anticipated in the second half of 2025. Dennis Igor for UBC News.